Okay, this is a continuation of Learning Module 2. And in this discussion, we'll be going over Chapter 5, which is business deductions. Now, again, in Chapter 4, we did gross income. So now in Chapter 5, we're going to discuss business deductions. So as noted, an expense is not deductible under federal law unless Congress creates a specific provision allowing it. So the Internal Revenue Code does explicitly allow the deduction of expenses incurred in a trade or business, but only if those expenses are ordinary, necessary, and reasonable in amount. So generally, an ordinary, necessary, and reasonable trade or business expense is deductible in full without limitation or restriction. So in Section 162, it permits a deduction for all ordinary and necessary expenses paid or incurred in carrying on a trade or business. And to understand the scope of this provision, it is critical to understand the meaning of the terms ordinary and necessary. So since these terms are not defined in the code or regulations, the courts have dealt with these terms on numerous occasions. An expense has been held to be ordinary if it is normal, usual, or customary in the type of business conducted by the taxpayer. Now, note that expense need not be reoccurring to be considered ordinary. So, example, a business may incur an expense related to a rare and unusual event. However, if other businesses in a similar situation are likely to incur a similar expense, the expense can be considered ordinary even though it is not recurring. So again, an expense has been held to be necessary. If a prudent business person would incur the same expense and the expense is expected to be appropriate and helpful in the taxpayer's business. So again, an expense has been held to be necessary if a business person would incur that same expense and the expense is expected to be appropriate and helpful in the taxpayer's business. So let's talk about the reasonable requirements. Okay, so again, generally an ordinary, necessary, and reasonable trade or business expense is deductible in full. So we talked about what's considered ordinary. We've talked about what was considered necessary. So now let's talk about the reasonableness requirement. An expense must also be reasonable to be deductible. So although the code applies the reasonableness requirement solely to salaries and other compensation for services, the courts have held that for many expenses to be ordinary and necessary, it must also be reasonable in amount. So if an expense is unreasonable, any amount in excess of what is reasonable is not deductible. So the question of reasonableness, that's going to be a tongue twister, usually arises with respect to closely held corporations where there is little or no separation of ownership and management. For example, excessive salaries, rent, and other expenses paid by a closely held corporation to its shareholders may be deemed unreasonable. What constitutes reasonableness is a question of fact. For example, the courts will view the reasonableness of a salary paid to a shareholder of a closely held corporation in light of all relevant circumstances and may find that unusually large salary is reasonable despite its size. If payments to shareholders that are initially treated by a corporation as salaries, rent, or other expenses are made proportionate to the percentage of stock owned by the recipients, the payments are generally treated as dividends. Because dividends are not deductible by the corporation, the disallowance results in an increase in corporate taxable income. So deductions for reasonable salaries will not be disallowed solely because the corporation has paid insubstantial portions of its earnings as dividends to shareholders. So just to kind of sum it up, an expense must also be reasonable to be deductible, and the code applies the requirement solely to salaries and other compensation for services. And the courts have held that for any expense to be ordinary and necessary, it must also be reasonable in amount. So if an expense is unreasonable, any amount in excess of that reasonable, in excess of what is considered reasonable is not deductible. So timing of deduction recognition. Okay, this is also very, very important. A taxpayer's accounting method is a major factor in determining taxable income. Again, we talked about cash basis, accrual basis, and then the hybrid. So the method used determines when an expense is deductible as well as when revenue is taxable. So usually the method regularly used by a taxpayer in keeping the books is used for income taxes purposes. So the code and regulations also require that the accounting method used clearly reflect income and that items be handled consistently. So the most common methods of accounting are the cash method and the accrual method. If a taxpayer owns multiple businesses, it is permissible to use the cash method for some and then the accrual method for others. Now, now under the cash method, just real quickly, just to kind of reiterate what they mean, expenses are deductible when paid, not when they're incurred. And the accrual method, expenses are deductible when the expense is incurred. So throughout the portions of the code dealing with deductions deferred, paid, or incurred will be used. And then a cash basis taxpayer is generally allowed a deduction in the year that the expense is paid, and an accrual taxpayer is allowed a deduction in the year in which the liability for the expense is incurred. So what are some of the cash method requirements for the deduction? So the expenses of cash basis taxpayers are deductible only when they are actually paid with cash or other property. So although promising to pay or issuing a note does not satisfy the actually paid requirement. So a payment made with borrowed funds is deductible. Taxpayers are also allowed to claim a deduction at the time they charge expenses on credit cards. Effectively, they borrowed money from the credit card issuer and then so simultaneously paid the expense. A cash basis taxpayer must actually or constructively pay an expense for the expense to be deductible, but payment does not ensure a current deduction. The regulations require capitalization of any expenditure that creates an asset, having a useful life that extends beyond the end of the tax year. So courts have clarified that expenses that provide a benefit beyond the end of the tax year following the year of payment generally must be capitalized. Thus, even cash basis taxpayers can only deduct such expenditures through amortization, depletion, or depreciation over the tax life of the asset. So basically what all that means is if you purchase if you make a purchase and of an asset that has a useful life of more than 1 year, then the what can be deducted is only what you like depreciate through or what you expense out through amortization, or what you expense out through depletion, or what you expense out through depreciation of that asset. Okay, so accrual method. So an accrual basis taxpayer can deduct an expense when both all the events test and the economic performance test are met. So what are those? Okay. So the all events test is met when all of the events have occurred to establish the existence of a legal liability, and two, the amount of the liability can be determined with reasonable accuracy. I think we talked about this when we kind of first mentioned these different accounting methods with the construction company that was under dispute because the customer claimed that they did not meet all specifications. So therefore, even though they were a accrual-based company, they could not claim the gross income until the next year when the settlement was able to be achieved, because it has to meet the all events test. The economics performance test is met when the party obligated to do something, and this again is part of the economic, yes. So you have the events test, and then you have the economic performance test. So again, the events test is when all of the events have occurred to establish the existence of the legal liability, and the amount of the liability can be determined with reasonable accuracy. And then the economic performance test must be met when the party obligated to do something to satisfy the liability does so. So, and again, that example that we did in chapter 4 about the construction company did not do the economics performance test. So in situations in which a liability arises as a result of services being provided or property being transferred to the taxpayer, economic performance occurs when the service is provided or the property is acquired. If the liability is the result of the taxpayer being required to provide services or transfer property, economics performance occurs when the taxpayer provides the service or again transfers the property. So expenses accrued to related parties. So regardless of the taxpayer's general method of accounting, the Internal Revenue Code places restrictions on the deductibility of expenses accrued to the related parties. Without these restrictions, related taxpayers who have control over both sides of a transaction would have the ability to enter into transactions that allow the immediate deduction of an expense by an accrual basis taxpayer, while allowing the deferral of the related income by a cash basis taxpayer on the other side of the transaction. So example, an accrual basis closely held corporation might borrow funds from a cash basis individual shareholder. At the end of the year, the corporation would accrue and deduct the interest expense, but the cash basis lender would not recognize interest income because no interest had been paid. All right, so section 267 specifically addresses related party transactions. So deferring the deduction of an expense accrued to a related party until the related party is required to recognize the item in income. So note that the deferral is not required if both parties use the same general method of accounting. Likewise, deferral will not be required if the related party reporting income uses the accrual method and the related party taking the deduction uses the cash method. So relationships and constructive ownership. So again, for purposes of section 267, related parties include the following: family members, including brothers and sisters, spouse, ancestors, and lineal descendants of the taxpayer. Corporations and shareholders who own more than 50% of the corporation's stock, and then 2 corporations that are members of a controlled group. So constructive ownership provisions must be considered when determining whether taxpayers are related for purposes of section 267. Under these provisions, certain taxpayers are treated as if they own the stock directly, owned by others. For example, the purposes of applying the test of 267, a taxpayer will be treated as owning any stock directly owned by his or her family members. All right, so prepaid expenses. just to kind of give you a recap, what is a prepaid expense? It is when you pay for a product or service prior to receiving it. All right. So special rules allows taxpayers, including accrual basis taxpayers, to deduct certain prepaid expenses. A deduction is allowed if the benefit they create doesn't extend beyond the earlier of 12 months after the first date on which the taxpayer realized the benefit, or the end of the tax year following the tax year in which the payment was made. So although this rule applies to both cash and accrual method taxpayers, it does not supersede the economic performance test. Therefore, if it does not apply to prepayments for services, property, or the use of property for accrual basis taxpayers, so it does not apply to the prepayments of services, property, or the use of property for accrual tax base unless economic performance has occurred. Nor does it apply to other expenses for which special rules regarding their timing exist. So prepaid expense eligible for the 12-month rule include insurance, dues, and license. So, all right, so public policy limitations. The courts initially developed the general principle that a payment in violation of public policy is not deductible. Although the payment may be helpful to a business and even contribute to its success, a deduction would in effect represent an indirect governmental subsidiary for taxpayer wrongdoing. So under legislation, based on this principle, deduction of the following expenses is specifically prohibited. Bribes and kickbacks, illegal under the federal or state law. 2/3 of the treble damage payments made to claimants resulting from violation of antitrust law. Fines and penalties paid to a government or governmental entity for violation of law. And of course, amounts paid to government or governmental entity for the investigation into the potential violation of any law. So for purposes of the above rules, any entity that regulates a national securities or commodities exchange is considered a governmental entity. So let's talk about expenses related to drug trafficking. Interestingly, the expenses of operating an illegal business that are not inherently illegal themselves are deductible. While allowing deductions for illegal activity may seem inappropriate, recall that the law taxes net income from a business operation, not gross revenue. So an exception applies to expenses incurred in illegal drug trafficking. Drug dealers are not allowed a deduction for ordinary or necessary business expenses incurred in their business except for cost of goods sold. Okay, so political contributions and lobbying activities. No deduction is allowed for direct or indirect payments for political purposes. Historically, Congress has been reluctant to allow deductions for political expenditures, even if those expenditures relate to a trade or business. Allowing deductions might encourage abuses and enable businesses to have undue influence on the political process. So non-deductible political contributions include payments made to support, participate in, or influence a campaign on behalf of a candidate for public office. Lobbying expenses are not deductible. Lobbying expenses include those incurred in attempting to influence any existing or potential legislation at the federal, state, or local level. They also include direct communications with certain high-ranking federal government officials in an attempt to influence their official actions or positions. So the disallowance extends to a pro rata portion of the membership dues of trade associations and other groups that are involved in lobbying activities. So there are two special rules related to the disallowance provisions. First, the disallowance provision does not apply to activities devoted solely to monitoring legislation. Second, a de minimis exception allows a deduction of up to $2,000 of annual in-house lobbying expenditures incurred by the taxpayer. In-house lobbying expenditures are those paid or incurred directly by the taxpayer rather than amounts paid to professional lobbyists or other third parties. So if in-house expenditures exceed $2,000, none of the in-house expenditures can be deducted. All right, so excessive executive compensation. The reasonableness requirements and its relevance to the deductibility of expenses paid by small businesses was discussed in the previous section. However, the reasonableness of other expenses, including those paid or incurred by larger businesses, has also gained the attention of Congress as well as the general public. So recall that allowing a deduction indirectly reduces the economic burden of an expense, allowing the taxpayer to share the costs with the larger tax-paying public. So in response to concerns over the reasonableness of compensation paid to executives of large corporations, Congress enacted a limitation of the deductibility of such compensation. So specifically, the code limits deductibility of the compensation paid to covered employees of publicly traded corporations to $1 million per year. So covered employees are defined as the CEO, the CFO, and the three other most highly compensated employees of the corporation. So any individual who qualifies as a covered employee any time after 2016 will continue to be covered will continue to be a covered employee in all future years, even if he or she no longer meets one of the above descriptions. Note that the provisions does not limit the amount of compensation that can be paid, but only the amount that is deductible. Quickly, the limitation does not apply to any compensation that is excludable from the executive's gross income. So before 2018, the $1 million limit excluded commissions and performance-based compensation. And contracts in place on November 2nd, 2017 are grandfathered into the pre-2018 law as long as there are no material changes to the contract. So expenses incurred in the investigation of a business. So recall that in section 162 allows a deduction for expenses incurred in carrying on a trade or business. However, expenses may be incurred to investigate the creation or acquisition of a business before the business is actually conducted by the taxpayer. Such costs might include travel, engineering, architectural surveys, marketing reports, and various legal and accounting services. How such expenses are treated for tax purposes depend on the current business, if any, of the taxpayer, and whether the acquisition actually takes place. So if the taxpayer is in a business that is the same as or similar to that being investigated, all such expenses are deductible in the year paid or incurred. So the tax result is the same whether or not the taxpayer decides to follow through with the expansion. If the taxpayer is in a business the same as or similar to that being investigated, the investigation expense are deductible in the year paid or incurred. So when the taxpayer is when the taxpayer is in business that is the same or similar of that being investigated, such as the taxpayer is investigating the expansion of an existing trade or business, all such expenses are deductible in the year paid or incurred. The tax result is the same whether or not the taxpayer decides to follow through with the expansion. When the taxpayer is not in business, is not in a business that is the same or similar to the one being investigated, the tax result depends on whether the new business is acquired. If the business is not acquired, the investigation expenses generally are not deductible. If the taxpayer is not in a business that is the same or similar to the one being investigated and actually acquires the new business, the expenses must be capitalized as startup expenditures. However, the taxpayer may be able to deduct up to $5,000 of startup expenses in the month in which businesses begin. This immediate deduction is reduced dollar for dollar by the amount total startup expenses exceed $50,000. So, so again, investigation expenses must be capitalized as startup expenditures. They may elect to deduct the first $5,000 of expenses currently, and then the immediate deduction reduced dollar for dollar by the amount total startup expenses by the amount total startup expenses exceed $50,000. As a result, the immediate deduction is totally phased out when total startup expenses reach $55,000. Any excessive expenses can be amortized over a period of not less than 180 months, which is about 15 years. So quickly, startup expenses include the following. Expenses incurred to investigate the creation or acquisition of a business by the taxpayer. These are like market studies. And then expenses incurred in creating or acquiring a business. These are incurring professional fees, identifying suppliers, obtaining licenses. Also startup expenses of investigation of a business, expenses incurred before the day the business begins that would otherwise have been like deductible under our section 162. These are salaries, utilities, advertising, etc. So interests and other expenses related to tax exempt income. In addition to expenses incurred in a trade or business, the law also allows taxpayers to deduct expenses incurred for the production of income. These are related to an activity engaged in for the purpose of generating income, but whose activities are not extensive enough to constitute a trade or business, such as in investment activities. Certain types of income are tax exempt. Together, these provisions could lead to unintended consequences. Now, to be more specific, the code generally, the Internal Revenue Code generally disallows the deduction of expenses paid or incurred to generate tax exempt income. The disallowance applies to interest expenses directly related to purchasing or carrying tax exempt bonds, as well as any other expense allocated to a tax exempt income. So the example here again, interest expense on loan were funds used to acquire bonds. So business interest expense. A limitation on the deductibility of business interest expense applies to large businesses. The deduction for business interest expense is limited to a taxpayer's business interest income plus 30% of the adjusted taxable income. So adjusted taxable income is taxable income calculated without considering the non-business income, gain, deduction, or loss, any business interest income or expense, the net operating loss deduction, and the deduction for qualified business income. So again, the taxpayer's business interest income for the year. So the deduction for business interest expense is limited to the taxpayer's business interest income for the year, plus 30% of the taxpayer's adjusted taxable income for the year. Amounts disallowed may be carried forward and used in future tax years. This does not apply to taxpayers with average gross receipts for the prior three-year period of 26 million or less. All right, so let's talk about expenses related to entertainment, recreation, or amusement. So taxpayers may incur costs to entertain potential or existing customers, clients, suppliers, employees, etc. These costs can be incurred either during or in association with a business meeting and may reasonably be considered ordinary and necessary trade or business expense. So however, due to the element of personal employment and the related potential for abuse, the deductibility of such expense might create Congress does limit this deductibility of these expenses. So generally no deduction is allowed for any costs related to entertainment, amusement, or recreation activities, nor are costs related to any facility, airplanes, yachts, stadiums, boxes, or hotel suites are used in such activities are deductible. So dues related to memberships in any business, social, athletic, or sporting clubs are also non-deductible. Business meals, including those paid in connection with business meetings, as well as those paid for employees, are generally deductible as long as they are not lavish or extravagant. However, any deduction is limited to 50% of the cost of the meals. The deduction for the cost of meals provided the deduction is limited to 50% of the cost of the meals, and the deduction of for the cost of the meals provided to the employees on an employer's business premises is also subject to the 50% reduction. The 50% limitation does have a number of exceptions. Expenses for meals or entertainment treated by the recipient as taxable income, expenses for recreational or social activities, primarily for the benefit of non-highly compensated employees. Other expenditures that are not deductible include capital expenditures and expenditures for which the taxpayer does not have adequate substantiation. Basically, expenditure for which the taxpayer does not have adequate substantiation. What does that mean? Meaning of substantiation is the act of showing something to be true. So supporting claims with facts. So a tax cannot deduct anything of which the taxpayer cannot substantiate is theirs to be true, to be factual, etc. All right, so research and experimental expenditures. Businesses may incur research and experimental expenditures in the development or improvement of products or processes. Taxpayers are allowed several alternatives for handling these types of expenses. A taxpayer must choose the method to be applied to the overall research program when filing the first tax return covering the program or project. So once chosen, a taxpayer may not change the methods without the permission of the IRS. So research and experimental expenses generally include costs to develop a product or process, the viability of which is uncertain when the costs are paid or are incurred. They include expenditures directly related to development, such as salaries, materials, as well as the cost of obtaining patents. They do not include the costs of routine quality testing, consumer research, or promotions, nor do they include the costs of land or depreciable property used in the research, although the depreciation on the property may be used as a deduction. The law also provides a credit for increasing research expenses over what the expense amount was in a base year. The amount otherwise deductible or amortizable is reduced by the available credit to prohibit the taxpayer from benefiting twice from the same expenditure. So let's talk about those methods. We got the expense method. In tax years beginning before January 1, 2022, a taxpayer can deduct all research and experimental expenses in the year in which they are paid or incurred. In certain instances, a taxpayer may incur research and experimental expenses before actually engaging in any trade or business activity. In such instances, the Supreme Court has applied the liberal standard of deductibility crafted by Congress in Section 174 and permitted a deduction in the year paid or incurred. Deferral and amortization method. So alternatively, in tax years beginning before January 1st, 2022, research and experimental expenditures may be deferred and amortized. If this election is made, then the expenditures are amortized. One over a period of at least 60 months, beginning in the month the taxpayer first realizes a benefit from the expenditures. 2, over a period of 10 years, beginning in the year the expenditure is made. All right. Lost my place. Here we go. In tax years beginning after December 31st, 2021, taxpayers will be required to capitalize and amortize all research and development expenses as described above, with 2 changes. First, the expenditures must be amortized ratably over a 5-year period, 15 years for foreign research, by the way. And then second, amortization will begin at the midpoint of the year the expenses are paid or incurred, rather than the month in which the taxpayer first realizes the benefits. All right, so issues related to other common business deductions. So in addition to the provisions discussed earlier, a variety of other expenses are subject to special rules and limitations. 2 of the more commonly encountered expenditures are interest expense. Generally, taxpayers other than large businesses are not limited in the amount of business interest expense they may deduct. However, the deductibility of interest from certain other activities may be limited. Further, deductibility of interest by individuals depends on the activity to which the interest relates. So since deductibility of interest expense associated with certain activities is limited, the IRS provides rules for allocating interest expense among activities. Under these rules, interest is allocated in the same manner as the debt with respect to which the interest is paid. The debt is allocated by tracing disbursements of the debt proceeds to like specific expenditures. The interest Tracing rules are complex and depend on whether loan proceeds are commingled with other cash and the length of time the loan proceeds are held before they are spent. All right, so taxes. As with interest expense, most state, local, and foreign taxes paid or incurred in a business or investment context are generally deductible. However, most federal taxes are not deductible. Although property taxes are generally deductible, the determination of a property owner's real estate taxes in the year in which property is purchased or sold may raise issues. Real estate taxes for the year in which the property is transferred must be apportioned between the buyer and the seller of the property. So the apportionment is based on the number of days the property was held by each during the during which the tax year. So apportionment is required whether the tax is paid by the buyer or the seller and is prorated according to the purchase agreement. So the apportionment determines who is entitled to deduct the real estate tax in the year of the sale. So the required apportionment prevents the shifting of the deduction for real estate taxes from buyer to seller or vice versa. So the date of the sale counts as a day the property is owned by the buyer. All right, let's talk about charitable contributions really quickly. Although charitable contributions are neither ordinary nor necessary business expenses, Congress allows all taxpayers to deduct certain contributions. The deduction is intended to encourage taxpayers to support organizations that provide social welfare needs to communities while reducing the costs that the government would incur to provide these services. However, since most expenses deductible under Section 162 are allowed without limitation or restriction, Congress expressly precludes contributions from falling under Section 162 and instead addresses them separately so as to define precisely what types of contributions are encouraged and how much encouragement will be provided. So a charitable contribution deduction is only available for contributions made to qualified organizations. And these include a state or possession of the United States or any subdivisions thereof, an entity created or organized in the United States and organized and operated exclusively for religious, charitable, scientific, literary, or educational purposes, or for the prevention of cruelty to children or animals. In no case is a deduction allowed for a contribution made to an individual. Contributions to qualified organizations must meet further requirements to be deductible. To qualify as a charitable contribution, a payment must be made with donation intent and with no expectation of a benefit or consideration being received from the organization. So in other words, not a bribe. These requirements, while impacting the deductibility of a contribution, also have potential consequences for the timing of the deduction. So recall that an accrual-based taxpayer may generally only deduct an expense when both the all events and economic performance tests are met. Since no consideration results from a contribution, a contribution can never meet the economic performance test. Rather, contributions are usually only deductible when paid. However, an exception allows an accrual-based corporation to claim the deduction in the year preceding the payment if two requirements are met. Okay. First, the contribution must be authorized by the board or the directors by the end of that taxable year. And second, it must be paid on or before the due date of the corporation's tax return. All right, so real quickly, kind of already went over this. So the contribution is paid. So real quickly, it can be to what is considered, sorry, the second requirement is, must be paid on or before the due date of the corporation's tax return, and that would be considered the 15th day of the fourth month uh, following the close of the taxable year, meaning April 15th. That's when the tax returns are due. Everybody knows the horrible date, April 15th. Everybody knows that day. All right, so let's talk about measuring non-cash contributions. A deduction is available for contribution of property as well as cash. How a non-cash contribution is measured depends on the type of property contributed. For this purpose, property must be identified as capital gain property or ordinary income property. So capital gain property is property that is sold, that if sold will result in a long-term capital gain or gain for the taxpayer. Ordinary income property is property that, if sold, produces income other than long-term capital gain for the taxpayer. Examples of ordinary income property include inventory and capital assets held 1 year or less. A contribution of yes. So again, that talks about FMV. Whenever you see that, it means fair market value. So again, capital gain property define assets that would produce long-term capital gain or gain if sold. So all right, so in some situations, a non-cash contribution must be measured at the lesser of its fair market value or its adjusted basis. So these situations include the following: contributions of ordinary income and property, and contributions of capital gain property that is also tangible and personal, but only if the property is not used by the organization in activities related to its tax-exempt purposes. All right, so limitations imposed on charitable contribution deductions. So both corporations and individuals are subject to annual limitations on the charitable contribution deduction. The limitations for individual taxpayers are covered in a later chapter. But for any tax year, a corporate's taxpayer contribution deduction is limited to 10% of the taxable income. For this purpose, taxable income is computed without regard to the charitable contribution deduction. So any capital loss carryback and the dividends received deduction, any contributions in excess of the 10% limitation may be carried forward to the 5 succeeding tax years. So any carry forward is combined with the contributions made in the carry forward year, with the total subject to the 10% limitation. So in applying this limitation, the current year's contributions must be deducted first, the carryover amount from previous years deducted in order of time. So let's talk about the carryover cost of recovery allowances. So tax payers may deduct or recover the cost of most assets that are used in a trade or business or held for the production of income. Depreciation refers to the periodic recovery of the cost of tangible assets, depletion to the recovery of the cost of natural resources, and amortization to the recovery of the cost of intangible assets. Depletion and amortization are discussed briefly later in this chapter, and this section is going to focus on the role and calculation of depreciation for tax purposes. So the tax rules for recovering the cost of business assets differ from the financial accounting rules. Historically, depreciation for tax purposes was computed using a various of financial accounting depreciation methods. However, Congress completely revised the depreciation rules in 1981 by creating the accelerated cost recovery system. excuse me, um, the accelerated cost recovery system allow the recovery of cost over like artificially shortened recovery periods with broader availability of accelerated methods. In 1986, Congress made modifications to this system, which resulted in the modified accelerated cost recovery system. Although the terms depreciation and cost recovery are often used interchangeably, the former refers to the allocation of costs over the periods they benefit for financial reporting purposes, while the latter refers to the recovery of cost for tax purposes. So depreciation is the refers to the allocation of costs for financial reporting purposes, and cost recovery refers to the recovery of costs for tax purposes. So cost recovery in general is available only with respect to qualifying assets used in a business or for the production of income. So identifying the particular assets that qualify and their basis is critical to determining the appropriate cost recovery deduction. So nature of property. So property includes both realty and personalty property. Realty generally includes land and buildings permanently affixed to the land, and personalty is defined as any asset that is not realty, which includes furniture, machinery, equipment, and any other asset that is movable. In summary, both realty and personalty can either be business use, income producing property, or personal use property. Assets used in a trade or business or for the production of income are eligible for the cost recovery only if they are subject to wear and tear, decay or decline from natural causes, or and assets that do not decline in value or that do not have a limited useful life are not eligible for cost recovery. And those are things like land, stock, and antiques. Personalty should not be confused with personal use property. Personal use property is any property, realty, or personalty that is held for personal use rather than for use in a trade or business or other income producing activity. Cost recovery deductions are not allowed for personal use assets. So let's talk more in depth about the modified accelerated cost recovery system. This is to assist taxpayers in applying the system. To assist taxpayers in applying the system, the IRS issues tables that provide annual cost recovery allowances based on the recovery periods, methods, and conventions specified by the Internal Revenue Code. However, those tables are based on depreciation methods and conventions that should be familiar to most accounting students. So these methods and conventions are below. So see if they have a table. So yeah, so these tables are based on depreciation methods that should be familiar to most accounting students. So let's talk about it for personal property. This system provides that the basis for eligible personalty and certain realty is recovered for 3, 5, 7, 10, 15, or 20 years. Property included in the different cost recovery categories. Let's see here. So most general purpose assets are have a recovery period of 5 to 7 years. And cost recovery for personalty in all but 15 to 20-year classes is based on a double declining balance depreciation. So this is what we're talking. This is what I was talking about. The class lives. You have 3, 5, 7, 10, 15, 20 years. Under 10 years or less, you have the 200% double, excuse me, my nose is running. Hold on a moment. Okay, hopefully my nose will quit running now. Cost recovery for personalty in all but the 15 and 20-year classes is based on the double declining balance depreciation. Switching to straight line when using straight line over the asset's remaining recovery period yields a greater deduction. Cost recovery of property in the 15 to 20-year categories is based on the 150% declining balance method. Cost recovery of all personalty generally incorporates the half-year convention. That is cost recovery in the year the asset is placed in service, as well as the year it is removed from service, and is based on the assumption that the asset was used for exactly 1/2 of the year, allowing a half year of cost recovery. So here's a slide describing that. So example is the recovery period for property with a class of 3 years begins in the middle of the year the asset is placed in service and then ends 3 years later. So in practical terms, that means that the cost of the personalty is actually recovered over 4, 6, 8, 11, 16, or 21 tax years instead of the 3, 5, 7, 10, 15, 20. So the mid-quarter, excuse me, convention, the half-year convention is based on simplifying presumption that assets generally will be acquired evenly throughout the tax year. However, Congress was concerned that taxpayers might override that presumption by placing large amounts of property in service towards the end of the taxable year, and by doing so, still receive a half year's cost recovery allowance. To limit this unintended benefit, Congress added the mid-quarter convention, and the mid-quarter convention applies if more than 40% of the cost of personalty is placed in service during the last quarter of the year. Under this convention, all personalty placed in service during the year is treated as if it were placed in the service in the middle of the quarter in which its use actually commenced. So property placed in service during the first quarter is allowed 10.5 months of cost recovery in the year in which it was placed in service. The second quarter, 7.5 months. The third quarter, 4.5 months, and the fourth quarter, 1.5 months. So straight line election. A taxpayer may elect to use the straight line method for depreciation of personal property. If the straight line method is elected, the basis of the property is recovered over the class life of the asset with a half-year convention or a mid-quarter convention, whichever applies. The election is available on a class-by-class and year-by-year basis. In other words, if the straight line election is made for any property placed in service during a year, it must be applied to all property with the same class life put into service during that same year. The percentages for the straight line election with a half-year convention would be an example. So let's look at so the percentage of the straight line election will have here up here. So let's look at an example. So Terry puts into service a new 10-year class asset on August 4th of 2020 for $100,000. He elects the straight line method of cost recovery. So Terry's cost recovery deduction for 2020 is $5,000. That's $100,000 times 0.05. His cost recovery deduction for 2021 is $10,000, which is $100,000 times 0.1. And if you look in your book, you can see where I get these numbers from in exhibit 5.7, and it gives you these percentages of what to use for the straight line election. Now, let's use this system for real estate. So the recovery period for residential rental real estate is 27.5 years. The cost for most real property is recovered using the straight line method. The recovery period, like again, I just said, for residential rental estate is 27.5 years. So residential real estate includes property where 80% or more of the gross rental revenues are from residential units. Therefore, hotels, motels, and similar establishments are not considered residential rental property. The basis of most non-residential rental real estate is recovered over 39 years. The cost of most real estate is recovered using the mid-month convention. Under this convention, in non-residential realty has a 39-year life, and any improvements made to this property would normally have a 39-year life. As discussed above, that the basis for most non-real estate is recovered over 39 years. Any improvements made to this property would normally be recovered over 39 years as well. So an exception to this general rule is provided for qualified improvement property, and the cost of qualified improvement property is recovered over a 15-year period using the half-year convention and the straight line method. So qualified improvement property is any improvement to an interior portion of non-residential real property made after the property is placed in service, including leasehold improvements. However, it does not include the cost of elevators or escalators or improvements that enlarge a building or modify its internal framework. The recovery percentages. Again, to look up the recovery percentages for these improvements, refer to Exhibit 5.7 in your textbook. Election to expense certain depreciable assets. So Section 179 permits taxpayers to immediately deduct up to $1,040,000 in 2020 of the acquisition of specific types of property used in a trade or business. The 179 expensing election is an annual election that applies to the acquisition cost of property placed in service each year. Property to which Section 179 applies includes primarily tangible personal property. However, it also includes computer software, qualified improvement property, and certain improvements made to non-residential real properties. Some of these improvements or examples are like heating, ventilation, air conditioning units, fire protection, alarm systems, security systems, etc. Amounts that are expensed under Section 179 reduce the assets basis for purposes of calculating any other forms of cost recovery, such as bonus depreciations. As a result, cost recovery deduction is calculated on the basis of the asset net of the Section 179 expense and any other additional first-year depreciation. Limitations. The Section 179 deduction is subject to 3 limitations discussed uh, uh, that we will discuss. So um, all right, so the first limitation we're going to discuss is the ceiling amount. So a taxpayer's section 179 deduction is subject to an annual limitation or an annual ceiling amount. That ceiling amount is 1,040,000 as of 2020. A taxpayer can choose to use all, part, or none of the annual Section 179 amount. If a business expects its marginal tax rate to increase in the future, it may decide not to use the Section 179 deduction. In such a situation, it may be better to defer deductions to those later years. As discussed, the business income limitation may also lead a business owner to choose not to expense assets. Property placed in service taxable. The Section 179 deduction is restricted to smaller businesses. This restriction is achieved by reducing the ceiling amount dollar for when Section 179 property is placed in service during the year exceeds a specific amount. Therefore, no Section 179 deduction is allowed in 2020 if 3,630,000 or more qualified property is placed in service during the year. So it cannot exceed a specific threshold amount. I think in 2020, that threshold amount was 2,590,000. Um, So business income limitation. Finally, the Section 179 deduction in any year is further limited to the taxpayer's business income. For this purpose, business's income is calculated by deducting all business expenses except for the Section 179 deduction. As a result, a taxpayer Section 179 deduction cannot create a net operating loss. For purposes of the limitation, an individual's business income includes income not only from a sole proprietorship, but also from wages and any allocated business income from a partnership or an S corporation. So any Section 179 amount in excess of taxable income is carried forward to future taxable years and added to other amounts eligible for expensing. The various limitations for that carry forward year are applied to the total amount of eligible property, including any amount carried over from previous years. So let's talk about, because I mentioned earlier that we were going to talk more about, that was it on depreciation for now. There's more in your textbook that I encourage you to read on your own. But that is it that I'm going to discuss regarding deductions and any kind of depreciation. So when we talked about depreciation, I said that later on in this chapter, we would discuss amortization and depletion. So real quickly, you're going to go over amortization. The cost of certain intangible assets are recovered through amortization, which is like depreciation, and it represents the periodic recovery of the cost of an asset. So amortization is usually determined using a straight line recovery method, and the most common and more amortized, I can't say that word, amortizable and more amortizable intangible assets include, that is a tongue twister and a half. These include startup expenditures, patents and copyrights, intangibles acquired as part of the acquisition of a business, including goodwill. So the amortization of startup expenditures was discussed earlier in this chapter. The costs of separately acquired patents and copyrights are amortized over their estimated useful lives beginning when the asset is placed in service. Amortization of intangibles acquired as part of the acquisition of a business is covered in section 197. Amortizable section 197 intangibles include most intangibles, including goodwill, uh, going concern value, franchises, trademarks, copyrights, patents, and covenants not to complete. So generally, self-created intangibles are not section 197 intangibles. The cost of section 197 intangibles is amortized over 15 years, beginning in which the month the tangibles is acquired regardless of their useful life. So again, it's talking about that the useful life of intangibles is about 15 years. And these include goodwill, going concern value, franchises, trademarks, copyrights, and patents and covenants not to compete. All right, so let's talk about depletion. Two methods of natural resource depletion. You have cost, which determined by using the adjusted basis of the resources and allocating it over the estimated recoverable units. And then you have percentage, determined using percentage provided in code and multiplying by gross income from resource sales. So natural resources are subject to depletion, a form of cost recovery that applies to natural resources. Land generally cannot be depleted, although all natural resources are subject to depletion. Oil and gas wells are used as an example of the following paragraphs that I'm going to read to you guys. So in developing an oil or a gas well, the producer typically makes 4 types of expenditures: natural resource cost, intangible drilling and developmental costs, and tangible asset costs, and lastly, operating costs. So natural resources are physically limited. Are limited, and the costs to acquire them are therefore recovered through depletion. So costs incurred in making the property ready for drilling, such as the cost of labor in clearing the property, erecting derricks, and drilling the holes, are intangible drilling intangible drilling developmental costs. These costs generally have no salvage value and are a lost cost if the well is not productive, or i.e. dry. Costs for tangible assets such as tools, pipes, engines are capitalized and recovered through depreciation. Costs incurred after the well is producing are operating costs. These costs include expenditures for items such as labor, fuel, supplies. Operating costs are deductible as trade or business expenses. Intangible drilling and development costs are depletable costs, receive different treatment. All right, so we'll talk more about cost depletion. All right, this resembles units of production depletion, because we talked, there's 2 methods of natural resource depletion. So now that we kind of talked about all the different expenses with pulling natural resources from the land, let's talk more about the depletion method. So you have, again, the cost depletion and the percentage depletion. So the cost depletion resembles units of production depreciation. The basis of the depletable asset is divided by the estimated recoverable units of the asset. So let's talk about coal. Coal is a really good example of this. So usually it is the basis of the depletable asset is divided by the estimated recoverable unit. So you purchased it for $120,000 and it has an estimated of 5 million tons. So you're going to take the 120,000 divided by 5 million, and that will give your depletion rate. And then you multiply that rate by how much you actually recover per year, and that gives you your cost depletion. The next we have percentage depletion, and it's similar to that, is that it's determined by multiplying the gross income from the sales of a natural resource by a specified percentage provided in the code. So again, certain percentages are used for you to multiply that against the gross income from the sales. Examples are like coal, which is another example that's usually most common. It has a 10% depletion, so you would multiply the gross income from the sales of that natural resource by 10%. The percentage does vary according to the type of mineral interest involved. So coal, I think like gravel is 5%, coal is 10%, gold and copper are 15%, and lead and cobalt are like 22%. Percentage depletion cannot exceed 50% of the taxable income from the property. Percentage depletion reduces basis in property. However, total percentage depletion may exceed the total cost of the property. All right, so that is it for chapter 5. Again, we'll be recovering chapters 4, 5, and 6 in learning module 2. So look out for a third video, which will be covering chapter 6.